Why are financial ratios so crucial to understanding a business's financial health? Well, let's dive in to unravel this mystery. First, we have liquidity ratios, which help establish a company's ability to meet short-term obligations. The current ratio, for instance, is determined by dividing current assets by current liabilities. So, if a company boasts $100,000 in current assets and $50,000 in current liabilities, the current ratio would stand at 2:1. This conveys that the company has twice as many current assets as liabilities, indicating robust, short-term liquidity. Moving on to the quick ratio, also known as the acid test ratio, it offers a more stringent measure of liquidity. It's computed by dividing quick assets, which are current assets minus inventory, by current liabilities. For instance, if a company has $80,000 in quick assets and $40,000 in current liabilities, the quick ratio would be 2:1, suggesting the company has twice as many quick assets as liabilities. Next, we explore profitability ratios, which measure a company's ability to generate earnings relative to sales, assets, and equity. The gross profit margin, for example, is determined by dividing gross profit by net sales. If a company has $200,000 in gross profit and $500,000 in net sales, the gross profit margin would be 40%. This implies that the company retains 40 cents from every dollar of sales after accounting for the cost of goods sold. The net profit margin, another profitability ratio, is calculated by dividing net income by net sales. Suppose a company has $50,000 in net income and $300,000 in net sales, the net profit margin would be around 16.67%. This signifies that the company earns approximately 16.67 cents in profit for every dollar of sales. Then, we have efficiency ratios, which assess how well a business uses its assets and liabilities internally. The inventory turnover ratio, for instance, is computed by dividing the cost of goods sold by average inventory. If a company has $400,000 in cost of goods sold and $100,000 in average inventory, the inventory turnover ratio would be 4. This indicates that the company sells and replaces its inventory 4 times within the period. The accounts receivable turnover ratio, another efficiency ratio, is calculated by dividing net credit sales by average accounts receivable. For a company with $600,000 in net credit sales and $100,000 in average accounts receivable, the accounts receivable turnover ratio would be 6, suggesting that the company collects its receivables 6 times within the period. Lastly, we'll look at solvency ratios, which evaluate a company's long-term solvability. The debt-to-equity ratio, for example, is calculated by dividing total liabilities by total equity. If a company has $400,000 in total liabilities and $600,000 in total equity, the debt-to-equity ratio would be 0.67, implying that the company has 67 cents in liabilities for every dollar of equity. The interest coverage ratio, another solvency ratio, is determined by dividing earnings before interest and taxes, EBIT, by interest expense. If a company has $200,000 in EBIT and $50,000 in interest expense, the interest coverage ratio would be 4, indicating that the company's operating income is 4 times greater than its interest expense. To summarize, financial ratios provide valuable insights into a company's liquidity, profitability, efficiency, and solvability. These ratios, when properly understood and applied, can make the task of assessing a company's financial health less daunting and more precise. Understanding these ratios is akin to mastering the language of business, empowering you to make well-informed financial decisions and strategies.